Welcome to Echo Trade. Today we are here with Brent and Chase Wilsey from Wilsey Asset Management. These guys are actually San Diego local to us here, just down the road in San Diego. We actually probably should have done this one in person, guys.
Could have.
Like a 15-minute drive, I guess. But hey, we're all used to doing everything online, so maybe next time. But anyways, so we're here to talk about you guys' concentrated value portfolio that's available within Echo Trade. And so, a little background on Brent and Chase. Their firm, Wilsey Asset Management, has been, I think, 5 years running Forbes Best in State Wealth Advisor here in California. And you've seen Brent and Chase, regularly on CNBC, CNN, Fox News, CBS Evening News. They've been on Dr. Phil recently, I think, just this year, and written articles for Forbes, down the line. So, good experts to lean on. But again, here to talk about the concentrated value portfolio. So appreciate you guys being here, and let's dive right in. So I kind of want to just start, from a broader 30,000 foot overview on the portfolio. We can kind of dive a little bit deeper into kind of some of the details, boots on the ground things. But overarching, kind of just give me a broad view of the portfolio. Just a couple sentences, a couple paragraphs on the high level goals. What's the overarching thesis and kind of goal for the portfolio.
Well, and I think we'll start off that we're very unique because we don't look at investing in stocks. We talk about buying small pieces of large companies. We like to call them equities, not stocks, because we look at business ownership. That's why we run the concentrated portfolio. We only will have 15 to maybe 18 companies in the portfolio. And it's not about the quantity of trades you do. It's about the quality. We spend a lot of time looking at these businesses as if we held and owned that whole buess.
And when you talk about the 15 to 18 stocks, we didn't just make that number up. Right. There is actually a financial formula that shows you. It actually shows you don't need 1,000, 100 different positions. You're not going to have any more risk to the portfolio than you would with 15 to 18 positions. So we would rather know a lot about 15 to 18 companies than maybe throw darts at a dartboard and pick 1,000 different stocks.
Yeah, because historically, you look at diversification as a major factor in terms of managing risk. And so kind of, not having all your eggs in one basket or just a few baskets. But so you look at firms that they'll put, 50, 75, 100 names, or companies, investments into one portfolio in the name of that diversification. But you guys are saying your viewpoint is that, and I think there's studies that back this, that, 15 to 18, you're pretty much taking all the diversification that's required for that risk management factor. Is that where you guys are coming from?
That's exactly where we come from. And we also talked to about, you see somebody like, oh, I got the stock went up 100%. Like, wow, how much was your portfolio? Well, 0.1%. It doesn't matter. That's why a concentrated portfolio works much better. And your risk does not increase. Your volatility will increase, but your returns will actually be better. And we won't tell anybody here it's a secret. That's one of Warren Buffett's secret. He has a very concentrated portfolio. Has had that for years. I don't think he has more than 15 major positions in the portfolio.
And the big thing we talk about with that diversification is you still need to make sure that portfolio is diversified. You don't want 15 tech companies in the portfolio. You want to make sure they're in different industries. So we make sure that we're not necessarily tripling up, quadrupling up on companies that are in that same industry. We want to make sure we have a good financial company, a good technology company. We make sure that portfolio is still diversified across industries, but can still do so with holding, again, around 15 to 18 different positions.
Gotcha. And you guys are kind of touching on a big topic that we want to cover already, that basically, which is risk. So how would we quantify risk of the portfolio, and what are you guys doing to mitigate that risk? And it sounds like, part of that is the diversification, which, 15 to 18 is going to cover that factor, but then also, not, even diversification in terms of the number of companies you're investing in, but also the different sectors. Is there anything else you guys are doing, to manage risk, or kind of the core components of the risk management strategy?
Well, Jeff, I want to comment on that because we always say that people get this confused: risk and volatility. Risk is where your money is going forever, never coming back. People get that confused with volatility. Volatility is just the up and down movements. If you're investing in good, solid businesses with good financial statements, good balance sheet, good income statement, good cash flow, that will come back. That is not risk. That is volatility. And people all the time get that mixed up. We are very low risk. But again, we do have volatility. Can't get it confused.
And the big thing we look at is, and we can talk a little bit more about our value strategy that we implement, but we don't take chances on high flyers. I mean, we talk a lot about like the cannabis stocks back in 2018 as a great example. Tilray was one of the popular ones. It's like $30 a share. And people said, Brent, Chase, time to get into cannabis. This is our opportunity. I think it went as high as $170 a share. And people said, see, I told you. You guys missed out. I said, this is just a big risk. Well, now we know Tilray's around $1.50 a share. That is risk. When you take chances on those high flyers, that is a risky thing to do. We avoid buying into businesses like the cannabis stocks, like the 3D printers. To be frank, we're not really hot on AI right now either, because it just doesn't fit what we do. Gotcha.
So that kind of leads to what types of companies you guys like to invest in. So it sounds like you're not investing in small cap, or which essentially small cap, lower capitalization, smaller companies, that maybe have a lot of upside, but there's a lot of that risk that you talk about that they could be gone in a couple of years. So are you guys investing more in kind of mid cap or large cap, some larger, household name companies, or where do you guys lie in terms of the types of companies you guys like to invest in?
We don't really look at the size of the company, small cap, mid cap, large cap. We look at, again, as the business. Now, one thing we can't do, we cannot invest in small cap companies because we do take a concentrated position. We don't want to own 5 or 6% of the company, and then we can't get out of it because we own too much of it. So we do like larger companies that are probably, I'm going to guess, maybe around $10 billion in market cap or higher. We just don't want to own too much of that, because when we want to sell out that business, we want to get out. We don't want to move that market. So it has to be probably at least a $10 billion, maybe larger market cap.
We do have a couple businesses right now that are in the $2 billion range. Really? Wow. Yeah. So it can happen, but I would say we wouldn't go anything less than $1 billion market cap. It's really our bottom threshold. But a lot of the companies that we invest in, people know, they'll recognize they're not, those businesses like, who is that? I don't know who that is. Or they sometimes can be like a holding company, and you say, oh, I know the businesses that they own, as an example.
Yeah. Got it. And so I want to circle back really quick in terms of, the goals of the portfolio. So just on a high level, are we, really looking for, long-term growth of the portfolio? Are we trying to generate dividends? Is this really kind of trying to capture some short-term gains? What's kind of the overarching goal within the portfolio in terms of, dividends, just pure growth, or limiting downside risk, or all included in there?
Well, and actually about 9 out of 10 companies we buy do pay dividends. And people don't realize, you go back to about 1930, about 40% of the total return of the S&P 500, the equities, has come from dividends. So we do like dividend paying companies, equities, because they do add to value over time. We have companies in the portfolio that we bought 10, 12, 14 years ago, that at the time we bought them, the yield was 3%. We're now getting a 12, 14% yield. So we do like dividends. But it comes back to looking at that business. We want to get a good, solid business that can grow on top of the dividends. And very important, we're value investors. We want to find businesses that are on sale. Maybe had some problem with accounts receivable or inventory, or something happened to where the equity fell from maybe 50 down to 35. Well, now we can get a nice, deal on this company. It goes back to 50. Wow, we made a great profit there. So we're looking for things on sale, is what we're doing.
And it does come down to that longer term approach. I mean, to be honest with you, we'd love to make a bunch of money every single year, but that's just not the reality when you invest. When you look at it on a year by year basis, you're going to have winning years, you're going to have losing years. But we always tell our clients, we tell people, hey, if you can average 8, 10, maybe 12% on average per year, that's a pretty good expectation to have with a good sound value approach. Now, again, it's not 8, 10, 12% every single year. You might have a year where you make 25%, a year where maybe you lose 5%. But over like a 7-year period, we tell people that's where we can look to average perhaps at 8 to 10, maybe 12%.
Gotcha. So you're really trying to go for the longer term gains, not really trying to capture. I mean, and maybe you'll have a good 3-6 month period, but that's not the point of the portfolio, is to jump in and out of the market. It's to have that long-term gains.
And the other thing too that readers need to, when they look at the news that we're looking at, is that we are very disciplined. It's a disciplined approach. I mean, we're not going to hold a company for 5 years just because we're going to hold 5 years. Every Monday we go over all the numbers of our companies. We've had companies that we sold after 6 months because they hit their target sell price, and we look at that every single week. We read the financial statements. Our average holding period probably is 3 to 5 years, we'll say, but that doesn't mean we're going to hold it just because that's our motto. If we buy a company at 10 and it goes to 15 in 6 months, and that's our target sell price, we will say, nope, time to get out of this company. It's overpriced, and we'll move on.
Yeah. And so talking about that, it's overpriced in the value. So that gets into kind of what your philosophy is in investing, so it sounds like you guys are value investors, and you'll explain this better than I can, but versus a growth investor, where I don't care if Nvidia has gone up 50% in the last 6 months, I still look at it as a strong growth company, and I'm going to invest in it right now. You guys are looking more so from the standpoint that, where the value of the portfolio or where the price is right now versus what you guys perceive the value to be. You think it's a good value right now, so you're going to invest from that standpoint. Is that where your kind of primary focus or philosophy is coming from?
Yeah, because I like to sleep at night. I've been doing this for 40 years. I don't get nervous. I don't get excited. Like, it's just like, we want things I can sleep with at night. I'm not worried about having the hot stock in our portfolio. I'm more worried for our investors and for our readers of the newsletter that when you invest with what we do, you feel good that, yes, it's going to be here today, tomorrow, and I'll make a nice profit. We're not going to hit the home run. You hit the home run. Who was a big baseball player Bean, what was his last name?
Barry Bonds?
No, Bean. He was
Billy Bean.
Billy Bean. Yeah.
Moneyball.
Thank you. My memory's not as good as his. So, but that's what we try to do, is hit those base hits. So we get those home runs and not worry about striking out all the time, because, again, I've been doing this for over 40 years. And I've made people a lot of money over time, as opposed to trying to make it very quickly and losing it. And it really comes back to that discipline. We do our homework, we do our research before we invest in any company. Yeah. It's 10, 15, maybe 20 hours of research to understand, is this really a business we want to get into?
And when we look at kind of the growth stocks, and, people that buy NVIDIA, congratulations, good for you. I mean, as a value investor, we're going to miss those. That's just the reality of investing. But if you look back at the history of growth stocks, the NASDAQ's a great proxy for that. You're going to have these big upswings at times. But you also look back to the tech boom and bust. If you look at the NASDAQ, it hit its peak in 2000, and then the bust occurred. It fell, I think it was 80, 90%. It didn't reach that peak again until the year 2015. So you made money. Your money is not compounding or growing over that time period. That is very hard on investors. That's why we like the value approach. Many times those can come down, but many times they come back much faster. And as we talked about, many of those companies paid dividends, so their money is still compounding and growing in the long term.
Got it. And so we talked about this a little bit earlier, that you guys are investing across sectors, trying not to pigeonhole yourself in just tech or just financials. So are there certain sectors that you guys are looking at, at all times, or is it obviously on different market conditions that you like? And what types of sectors do you guys, or how many sectors do you guys like to kind of make sure to have that sector diversification?
We look more at industry. We're looking for industries to go on sale. A good example comes to my mind is a couple of years ago, like, oh my gosh, oil was down so low. Nobody wanted oil. Oh, it's over for oil. We said, wait a minute. Oil is trading at such low levels. We get these companies on sale. And then sure enough, after we got through COVID, they skyrocketed. That's what we look for. Not just businesses, but industries that are maybe out of favor, and we'll be back in favor in 2, 3, maybe 4 years. We'll make those big gains because we got something on sale.
And one thing we kind of look at as a more up-to-date example is real estate. Is another industry we really like, is as these interest rates have kind of risen, it's really spooked a lot. And, a lot of the real estate stocks, those companies, the baby's been thrown out the bathwater, essentially. There's good, sound real estate businesses that have fallen 50, 60, 70%. Now you get these astronomical dividend yields on them. We have a couple of those in the Echo Trade portfolio. We think those could be the big winners come maybe 2024, 2025, perhaps. That's kind of what we're looking at this point. And being patient with the right businesses, that's when the time does pay off.
Got it. No, that's really interesting the way you guys kind of approach that. I guess to wrap it up, why this portfolio for Echo Trade? What makes this portfolio different from others, and kind of why would you want to offer this specific portfolio within Echo Trade?
This is one that you can sleep with at night, as I kind of said. You're going to invest in it. You're going to find good companies that we're investing into. You don't have to worry about, oh my gosh, I'm going to lose my money tomorrow. It's not very exciting. We tell people, you invest with us, you go to a party, you go in the corner, you'll be by yourself talking. We're not going to buy the high flyers we talked about, but you're going to have good, solid businesses that were on sale. You can sleep with us. And again, we look at growing people's wealth long term. That's what we look at, because once you lose money, and it's funny, rich people understand this. Once you lose money, you can't make it back, or very hard to make it back. So I think Warren Buffett said number one rule was don't lose money. Well, that's what we look at. We don't want to lose money.
What was his number 2 rule?
Don't forget rule number 1.
Exactly.
You knew that, didn't you?
Yeah.
And I mean, the big thing we look at too with the value investing is, I'll be very honest with people, it has not been the place to be as of late. But if you look over history, value investing has done very, very well. In fact, if you go back over history, value investing over 5-year periods outperforms the stock market, those 5-year periods, about 84, 85% of the time. I'll give you a little secret. It hasn't outperformed over the last 5 years. I think that means over the next 5-10 years, value investing could be a very, very strong place to be for the investors that are patient and willing to sit out with the right companies.
Well, that's fantastic. I appreciate it, guys. And, investors, they can learn more on EchoTrade and see the concentrated value portfolio from Wilsey Asset Management. Appreciate you guys for being here. Thanks.
Thanks for having us.
Thanks for having us. Yes.